This is Brad, the Humble Trader. I just want to do my first video post. I think it will cut down on some time for me, and this way I think I'll be able to show my charts a bit more efficiently. So I just want to do a quick market recap and also show some gold charts. Sorry if I speak fast, but I don't want this to be a long post. So let's just start with the SPY, which is the ETF of the S&P 500. I just want to show you 2011. I think the market is showing identical, I wouldn't say identical, it's showing similar characteristics to 2011. A couple of months ago in my earlier posts, I was trying to work out whether it looked like more like 2011 or 2008, but I think with the breadth that I've shown in the last few posts, breadth has been so strong, it's more like the start of a bull market than the end of a bull market. So I just think that this market is probably going to make new highs, but I take the market a week at a time, and if the market proves differently, then I change my mind pretty quickly. So right now, I just think that it looks similar characteristics to 2011. So I just want to go over this chart here and show a couple of things. When you look at 2011 here, when it broke the highs, I think that we're either in the process, in this sort of process here, or in this process here. Either way, where we are today, the market is very overbought on a short-term basis, and I think we need some sort of a pullback. And then we'll see the characteristics of that pullback. I think it will be either similar to this here or similar to this here. I think if we do, we're very close to the highs now. I think if we break those highs, then we'll pull back to support, and then we'll gun ahead with more strength over the months to come. But so if you have a look at the accumulation distribution, the on-balance volume, they're really good indicators of volume and participation to show you that the big money, the money's in and participating in the market. They can be good leading indicators, not always, but they typically are. The momentum indicators are more lagging indicators and more for a market that's showing good momentum. I use both, but particularly I use these two because they're very good leading indicators. So whether we're at this stage here and we need a pullback, or we're coming up to the highs, we're going to break the highs, either way we need to be careful, because I think we're going to get a short-term pullback. So this is where we are now. The on-balance volume has broken through the trend line. We've got really strong accumulation. You don't fight this accumulation. It means that the big players are buying this market, even though you can see that there's not huge volume in the market, but there's still participation. So until these turn down, then you wouldn't really need to fight this market right now. So are we going to form a sort of a triple top here? Or in this case, it's kind of, it's going to hit resistance on the 5th time, but it's going to be very hard for the market to break through here. If it doesn't, then these momentum indicators are quite overbought and have been. We have divergences also. So will this market break through like this point in 2000 and then come back, retest and gun a little bit higher? Or like this sort of area here, will we have a nice sharp pullback and then move on to and break those highs? So I just think that either way, whether we pull back here or break through, it's not going to last long. We should have some sort of a pullback, maybe back to the 200 moving average or the 50 or 100. But once again, these two indicators are going to show you in advance what's going to happen, or at the very least, they're going to confirm. Don't fight these two indicators. I suggest that people use them. They're very good. So, okay, so that's sort of a short market wrap. What I show you now is just a few gold charts. Excuse me. First chart I want to show you is the gold or it's the GLD, which is the gold ETF, relative strength chart to the S&P 500. Okay, so relative strength chart, when you're comparing these two indexes or a commodity index, it doesn't matter what it is, whether it's stock to an index or stock to a commodity. The first, in this case, the commodity, we're comparing the GLD ETF to the S&P 500. So if this relative strength chart is going up, then it just means that the gold is stronger than the S&P 500. Okay, it's pretty clear. So if you look at this chart, when it's breaking some fairly significant resistance, my two indicators have crossed, then you get a good, and this is a weekly chart too also, so you get a good intermediate term buy signal on gold. But at the same time, if you can see all my green dots, every time it's broken, you've got a good run in gold. But this is a relative strength chart. Doesn't mean that the market's going to go up. The markets could be going down, and if gold is strengthening in comparison to the market, to the S&P 500, it could be just going down less than the market. Okay, so you have to take that in consideration, but generally, especially in a bull market, then that will signify that gold is strong. So as you can see here, from the last bottom in gold, we've broken that significant resistance, and we have that crossover, right? So that's a really good, strong intermediate buy for gold over the market. So if you were to choose over commodities or over precious metals to the market, then you at this point in time right now, you would put your money with precious metals over the stock market. Okay, so I want to show you the next chart, which is this silver to gold relative strength chart. Okay, similar story. What this chart shows, on the bottom here we have silver, the price of silver. On the top we have the S&P 500. So this relative strength chart is really good at picking bull markets in both silver and the market. Now, silver is seen as a risk-on commodity. So every time this relative strength chart gets down to this level, as you can see all these green dots, then it's very oversold. So silver is very oversold in comparison to the price of gold. When it does that, typically it's formed a long-term bottom with silver. Okay, as you can see here, 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 and here. And then you also get confirmation once it breaks out of one of these long-term resistance levels here, like here, here, and here. Typically, we've got good setups in silver. So it's just something to keep aware of. If you're investing in precious metals, silver is a good place at the moment to put your money over gold. That's all this market shows right now. But it also, and this is the thing, with this chart, every time that it's hit these levels, you can see that you've had a really good run in both silver and the stock market. But at this time here, it didn't work so very well. The correlation broke in this level here, where we're from this point here. Excuse me. This relative strength was going down, and the market kept going up. So it broke down there, but still, we're at this level now where in history shows that when it gets down to these levels, it's a good place to buy the market and buy silver. So this is just another confirmation of what I'm talking about with the market. I think that it's going to surprise a lot of people, and the market may, after a short-term pullback, I think it might take off again. But again, I could change my opinion on that pretty quickly. So as you can see here, we have that breakout. So we've got the long-term low, and we've got the breakout. So it's just something to be aware of if you're investing in precious metals. Silver at this moment is a good place to be. So let's also look at, this is the GDX, which is the gold mining index in comparison to the price of gold. If you see these rising levels, so when the gold mining index rises in comparison to the price of gold, we have a strong gold market. It's, as you can see, it's broken this resistance level here, the pink 30 EMA exponential moving average is pointing up. So right at this point right now, then the gold miners, if you want to invest in gold, then it's you'd be preferential to invest in the gold mining companies rather than the price of actual gold. As you can see, these red areas here, gold miners, when this relative strength chart breaks down, tends to lead the price of gold. So if you see the price break down, then you definitely want to not invest in gold, or at least just be careful and look out for some sort of breakdown process. So let's have a look at, so if you were to invest in the miners, then actually the junior miners, the GDXJ, which is the junior mining index, this is showing strength over the GDX. The GDX is the higher, the larger capped mining stocks. The junior miners are the lower caps, so they're the more speculative plays. But if you're going to invest, these are the places where you can make some quick money. So here's the ratio here, the GDX in comparison to the junior miners to the GDX, showing very strong strength. Okay, so you've got the GDX showing strength over gold, and here you've got the GDXJ, the junior miners, showing strength over the GDX. But this is, at the moment, it's short term. It's quite overbought. I mean, this could keep gunning higher, but we've got some pretty overbought momentum indicators with negative divergences. I would typically wait for a pullback to either of these three moving averages. You use your Fibonacci levels and look for a reversal from there, maybe an oversold condition in some of these momentum indicators. But once again, if you look at the on-balance volume and the accumulation distribution, it's a very good way of getting in, timing, getting back into the market. So, okay guys, just a reminder that this is just for educational purposes. I'm just showing you what things I look at, so please don't trade based on this information. Do your own due diligence, and I'll post another video next week, I guess. Thanks guys.